You know, in the time it takes for you to just blink your eyes, trillions of dollars can change hands across the globe. It's all driven by this hidden force, algorithmic trading. It pretty much shapes our entire financial world, but for most of us, it's a total mystery. So today we're going to pry open that black box.
So let's start with a thought experiment. What if you could trade without any of the messy human emotions? Without fear, without greed. Imagine a trader who never panics, never gets greedy, and can make a million perfect decisions before you've even had your first sip of coffee. Well, that's not science fiction. That is the fundamental promise of algorithmic trading.
So, to really get why we even need these trading bots in the first place, we actually have to start by looking in the mirror. We need to understand why humans, for all our smarts and intuition, are often the weakest link in the chain of modern finance.
And this right here, this lays out the central conflict perfectly. On the left, you've got us, the human trader. We're slow, we're emotional, we make mistakes. That little voice in your head screaming sell during a dip, or the greed that makes you hold on too long, that's what we're talking about. But on the right, that's the ideal trader. It's a machine. It's logical, precise, and completely unemotional. It's exactly what you'd want managing your money. Okay, so if the human trader is the problem, then technology has to be the solution, right? This is the moment where algorithms, these automated, computerized trading systems, step onto the stage and completely change the game. So what is algo trading, really? At its heart, it's actually pretty straightforward. You just give a computer a super specific set of instructions. You tell it, hey, watch for these exact conditions, and the second you see them, execute a trade. The whole point is to do this way faster and way more often than any human being possibly could. And this gets right to the core of why computers are perfect for this job. They were built for repetitive, rule-based tasks. They never get bored, they don't get scared, and they certainly don't get greedy. As long as the code is right, they will follow their instructions to the letter every single time, without question. So how does one of these bots actually work? It might sound incredibly complex, like something out of a sci-fi movie, but there's a really simple analogy that makes it all just click. Just think of a trading bot like it's a self-driving car. Its sensors are the constant stream of live market data. It's always watching the road. Its navigation system comes from the trading signals that tell it where to go, when to buy, or when to sell. The steering wheel and the gas pedal, that's the execution logic, the part that actually places the orders. And of course, you have the safety systems. That's your risk management, designed to slam on the brakes to prevent a catastrophic crash. So let's break that down into the real-world parts. The market data is the bot seeing all the prices. The trading signals are the brains analyzing everything to spot an opportunity. The execution logic is the muscle, placing the trade as fast as physically possible. And maybe the most critical piece of all is the risk management. That's the kill switch, the one thing that's supposed to prevent a tiny error from turning into a full-blown financial disaster. All right, we know the parts, now let's get into the brain of the operation, the actual strategy. These strategies are all based on fundamental ideas about how markets behave. Ideas that, funnily enough, often come straight from human intuition. And here are two of the most common strategies, and they are complete opposites. On one hand, you have trend following. This is basically the idea that momentum is king. If a stock is going up, it's going to keep going up. You're trying to ride the wave. The motto is buy high, sell higher. But on the other hand, you have mean reversion, which assumes the exact opposite. What goes up must come down. It bets that huge price swings are just temporary mistakes, and it tries to profit when the price snaps back to its long-term average. It's your classic buy low, sell high. But, and this is a huge but, all of this incredible speed and automation comes with some absolutely enormous risk. These systems are unbelievably powerful, but they can also be incredibly fragile. And when they break, they tend to break in the most spectacular ways imaginable. Just stop and think about that for a second. A company's entire fortune, billions of dollars, all resting on a bunch of code. What happens if there's just one tiny bug, a single typo? What happens when that simple error gets multiplied a million times a second? This happens. $440 million. And that is not a hypothetical number. That is the actual, real-world cost of a single software bug for one company. This is the now infamous story of Knight Capital. Back in 2012, a bad software update caused their systems to just go haywire. In 45 minutes, less time than your lunch break, the company had bled out nearly $500 million. It was enough to push the entire firm into bankruptcy. Gone. just like that. And this brings us to a really critical idea: software implementation risk. See, this isn't about having a bad strategy. This is about the technology itself failing. And as the Knight Capital disaster proves, this is often the single most dangerous and most overlooked risk in the entire business. So, given this immense power and this terrifying peril, what does it all mean for the world of finance today? Well, it means Wall Street isn't really a place on a map anymore. It's a technological battlefield. Welcome to the new arms race. We're talking about firms using insane, specialized hardware just to react in less than a millionth of a second. They're literally building private microwave tower networks just to shave off a few microseconds from their data transmission times, because microwaves are faster than fiber optics. The code they write is so valuable, it's locked down with ironclad secrecy agreements. It is a nonstop world of innovation where a single millisecond can literally be worth millions of dollars. As one expert put it, algorithmic trading is an extremely competitive and rewarding business and draws some of the brightest minds in the world. The stakes are just unbelievably high, the competition is absolutely brutal, and it attracts some of the most brilliant mathematicians and computer scientists on the entire planet. And all of this leaves us with one final and really important question. As our markets get faster and more automated every single day, we have to ask ourselves, in a world where machines are making all the decisions, who or what is actually in control?